Imagine waking up every morning thinking you're going to make money trading, but by the end of the day, your account balance looks like it went through a hurricane. Day trading can be thrilling, but without the right strategies, it can also be brutally unforgiving. One of the biggest mistakes traders make is focusing only on profits and ignoring the very real possibility of big losses. Avoiding major losses isn't just about luck, it's about having a plan, discipline, and a clear understanding of risk. First, you need to understand the concept of position sizing. This means deciding how much of your total trading capital you are willing to risk on a single trade. For example, if your account has $10,000 and you decide to risk 1% per trade, the maximum you are putting on the line is $100. This small percentage may seem insignificant, but over time it protects your account from catastrophic losses. Another crucial factor is setting stop-loss orders. A stop-loss acts like a safety net that automatically sells a position when it reaches a predetermined price, preventing emotions from taking over your decision-making. Many traders make the mistake of moving stop-losses further away when a trade goes against them, hoping the market will turn around. This is a fast track to wiping out your capital. Understanding market volatility is also essential. Some stocks or assets move wildly, and if you trade without accounting for these swings, you can be stopped out too early or caught in a massive downward move. That's why it's important to measure average true range, ATR, or use technical indicators to know how much a stock typically moves in a day before placing your trades. Day trading isn't just about jumping on trends, it's about protecting your money while finding opportunities. Learning to accept small losses quickly without letting fear or greed dictate your next move is the cornerstone of avoiding big losses. Emotional control isn't optional, it's critical. Traders who panic or chase losses often compound mistakes, turning a manageable setback into a financial disaster. The goal isn't to avoid all losses, they are inevitable, but to make sure that no single loss or even a series of losses can destroy your account. That mindset alone separates successful day traders from those who burn out in months. Finally, keeping a trading journal where you note every trade, the reasoning behind it, the outcome, and lessons learned can help you see patterns in your mistakes and prevent repeating them. Reflection and continuous learning are your insurance policies in the volatile world of day trading. Now that you understand the basics of protecting your capital, let's talk about advanced strategies that help day traders avoid big losses. One of the most effective tools is the concept of risk-to-reward ratio. Before entering any trade, you should know exactly how much you are willing to risk and how much potential profit you're aiming for. For instance, if you risk $100 on a trade, you should ideally aim for at least $200 in potential profit, giving you a 1-to-2 risk-to-reward ratio. This way, even if half your trades fail, your winning trades can cover the losses and generate overall profit. Another crucial tactic is diversification within day trading. While day trading usually involves short-term trades, it's still possible to diversify across sectors, stocks, or asset types. Relying on a single stock or sector increases your exposure and the likelihood of a big loss if that market suddenly moves against you. Discipline is the backbone of risk management. Many traders fall into the trap of overtrading, taking too many trades in a day out of boredom, excitement, or the fear of missing out. Overtrading not only increases transaction costs, but also magnifies the risk of mistakes and emotional errors. It's far better to wait for the setups that match your trading plan perfectly than to trade impulsively. Position scaling is another method to control risk. This involves starting a trade with a smaller position and gradually increasing it as the trade moves in your favor. If the market moves against you, your initial small position limits your losses, but if it moves favorably, adding more gradually maximizes gains while keeping overall risk manageable. Understanding market news and economic events is also critical. Sudden announcements, earnings reports, or geopolitical events can trigger extreme volatility, often wiping out unprepared traders. Having a calendar of key events and knowing when to avoid trading or reduce position sizes can prevent unnecessary unnecessary big losses. Lastly, psychological preparedness cannot be overstated. Many traders know the rules, but fail to follow them because of emotions like greed, fear, or overconfidence. Practicing mindfulness, maintaining a clear plan, and sticking to your risk management rules, even when tempted to ignore them, ensures that no single moment of panic or excitement can destroy your account. Remember, in day trading, the game isn't just about making money, it's about surviving to trade another day. Even with all the rules in place, many day traders still fall victim to avoidable mistakes that lead to big losses. One of the most common errors is trading without a clear plan. Jumping into a trade because it looks like it might go up is a recipe for disaster. Every trade should have a clearly defined entry point, exit point, stop-loss level, and risk-to-reward ratio. Without this framework, decisions become emotional, and emotions are the enemy of consistency. Another frequent mistake is ignoring liquidity. Some stocks or assets have low trading volume, which can make it hard to enter or exit positions at favorable prices. Trying to trade illiquid assets can result in getting stuck in a position or suffering slippage, where you end up buying higher or selling lower than expected. Big losses often occur when traders let small mistakes snowball. For example, after a losing trade, some traders try to win it back immediately, increasing position sizes or ignoring stop losses. This impulsive behavior multiplies losses and can wipe out a significant portion of their account in a very short time. Overconfidence after a winning streak is equally dangerous. Just because you've won a few trades in a row doesn't mean the market will bend to your favor. Many traders increase risk after a streak, forgetting that each trade is independent and that losses are always possible. It's also important to recognize the impact of fees, commissions, and spreads. Day trading often involves frequent trades, and these costs can quietly eat into profits or amplify losses if ignored. Planning for them in advance ensures that your risk calculations remain accurate. Another key factor is using leverage cautiously. Leverage allows you to control a larger position with a smaller amount of capital, but it's a double-edged sword. While it can magnify profits, it also magnifies losses. Many traders get over-leveraged and find themselves in positions where a small market move wipes out a huge percentage of their account. Lastly, avoiding revenge trading is crucial. After a significant loss, emotions can tempt you to jump back into the market immediately to get even. This almost always leads to further losses because decisions made out of frustration or anger are rarely rational. Learning to step back, analyze, and wait for the next setup is far more effective than trying to chase losses impulsively. The consistent theme here is discipline. The best way to avoid big losses is to prepare, stick to rules, and treat trading as a strategic game, not a gamble. Now let's focus on practical tools, setups, and daily habits that can significantly reduce the chances of suffering big losses in day trading. One of the most effective tools is pre-market analysis. Before the market even opens, experienced traders review news, earnings reports, economic data, and key support and resistance levels. This preparation helps identify high-probability setups and alerts you to situations that could lead to sudden, unpredictable moves. Equally important is using technical indicators wisely. Indicators like moving averages, relative strength index, RSI, Bollinger Bands, and volume analysis can provide objective insights into market trends and potential reversals. However, overloading your charts with too many indicators can cause confusion and slow your decision-making. Keep it simple. Focus on the indicators that align with your trading strategy. Another habit that separates successful traders from those who face big losses is having a daily trading checklist. This checklist can include reviewing pre-market analysis, confirming entry and exit criteria, checking news events, and ensuring your stop-loss levels are in place. Following a checklist reduces emotional errors and helps maintain consistency, especially on volatile trading days. Risk management apps and trading platforms also offer tools like guaranteed stop losses or alerts that notify you when a position reaches a certain price. Using these tools ensures that even if you step away from your desk for a short time, your account is still protected from sudden adverse moves. Practicing proper position sizing every day is critical. Never let a single trade exceed your predetermined risk percentage. Many traders fail because they get caught up in a hot stock or a trending asset and throw caution to the wind. Consistently sticking to small, controlled positions protects your account from catastrophic losses. Journaling is another daily habit that cannot be overstated. Recording every trade, the rationale behind it, the outcome, and the lessons learned creates a personal database of experience. Over time,
time, patterns emerge that reveal which setups work best and which behaviors lead to losses. Finally, mental preparation is part of your daily routine. Take a few minutes each morning to visualize sticking to your plan, controlling your emotions, and responding calmly to unexpected market moves. Mental rehearsal strengthens discipline, making it easier to follow your trading rules in real time. By combining these habits, pre-market analysis, simple technical indicators, checklists, proper position sizing, journaling, and mental preparation, you create a systematic approach that minimizes big losses and sets the foundation for long-term success in day trading. Finally, let's bring everything together and discuss advanced strategies and the mindset needed to truly avoid big losses in day trading. One advanced approach is using multiple time frame analysis. This means looking at both shorter time frames, like 5-minute or 15-minute charts, and longer time frames, like hourly or daily charts, before making a trade. Aligning your trades with the overall market trend on higher time frames reduces the risk of being caught on the wrong side of a sudden move. Another key strategy is risk layering. This involves breaking your capital into multiple smaller trades instead of putting it all on a single position. By doing this, even if one trade goes against you, the rest of your portfolio remains protected, and you can adjust your positions as the market unfolds. Hedging is another technique used by advanced traders to mitigate potential losses. For example, if you have a large position in a volatile stock, taking an opposite position in options or a correlated asset can act as insurance against a major drop. While hedging isn't necessary for every trader, understanding how it works can prevent catastrophic outcomes during extreme market volatility. Beyond strategies, cultivating the right mindset is perhaps the most critical factor. Accept that losses are part of trading. They are unavoidable but manageable. Avoid chasing losses, stay disciplined, and focus on process over outcome. Successful traders view day trading as a series of probabilities, not certainties. This probabilistic mindset allows you to take consistent, calculated risks while keeping potential losses under control. Continuous learning is also essential. Markets evolve, and strategies that work today may fail tomorrow. Regularly reviewing trades, studying new techniques, and staying informed about market conditions ensures that your risk management remains sharp. Finally, remember that avoiding big losses isn't just about rules or tools. It's about respecting the market and respecting your own capital. Treat every trade as a calculated experiment, stay disciplined, and protect yourself first. Over time, this approach doesn't just preserve your account, it allows compounding, consistent growth, and the psychological confidence to trade without fear. The traders who survive and thrive are not the ones who never lose. They are the ones who consistently control their losses, follow their plans, and treat every trade with discipline and respect. Mastering this balance between risk and reward is the ultimate key to long-term success in day trading.